Goldman Sachs CEO David Solomon moonlights as a DJ, but when the company reported Q4 earnings on January the 17th, it wasn't music to investors' ears. Goldman Sachs, which we rate at 6 out of 10, missed profit earnings and ranked third amongst Financial Pro's investment bank searches last month, according to data from Trackstar, our proprietary sentiment indicator. Yet it was last on that list post-earnings. The biggest earnings miss in a decade saw Goldman shares plunge more than 8% the following day. Historically, Goldman has been a winner, and Financial Pros are taking a hard look at the stock after that dip. Now, Goldman specializes in investment and consumer banking, trading, wealth, and asset management. It ranks first in M&A transactions, but makes most of its revenues from global markets in fixed income, currencies, and commodities. Before its Q4 earnings, Goldman's had 9 straight quarters of double-digit returns, but after the disappointing results, the firm announced it would lay off 3,000 employees. Revenues rose to a record high in 2021, but the firm fell well short of this number in 2022. The company's revenues dropped sharply across most business lines thanks to a deterioration in deal flow. Goldman called Q4 an outlier and is reorganizing to focus on its strengths. The firm's finances still look healthy though, and it has an attractive dividend yield. And Goldman has a PE gap ratio that is better than Morgan Stanley's, but it's higher than its other peers. And it's a similar picture for price to sales ratios too, though it scores well on price to cash flow comparisons. Net income margin was down in Q4, however it's stronger than most peers, and it sits mid-table in return on equity. Falling revenue and shrinking deal flow isn't a train we want to be on. We believe it will take a few quarters to see recent readjustments pay off. Goldman is a good company facing a rough time, and it currently trades above $349. We'd buy on dips into the $280 to $300 range.